Yeah, I know, but there's only 8 people. So I'll wait just a few more minutes.
Good morning, everybody. We're just giving it a couple of minutes for more participants to join us, okay?
All right, I think we'll go ahead and get started in the interest of everybody's time this morning. Again, thank you for joining us for what is our 4th session. It's 3B. If you were with us last week, you know, we talked about low-income tax credits. So our session today, 3B, is tax-exempt bonds, which is another method of financing your project. This is a 4th in the series of the FNO FNO Developer Webinar Series. And again, we want to remind you that as of last week, FNO is now Finance New Orleans. So it's FNO, and they feel like that's going to better reflect what they're doing. So I am Valerie Robinson, one of the moderators, and Lucinda Williams. I say that every time. Lucinda Flowers.
I've gotten that many times before. So.
Is my partner in this, and will be assisting with the programming today. Lucinda is an experienced in affordable housing policy, advocacy, and communications. She started her own consulting firm 4 years ago, and she's focused on grant writing and communications.
Good morning, everybody. This is Lucinda Flowers. Valerie, again, my partner and colleague in this work for Finance New Orleans, which we're very happy to be doing, is she has owned her own firm, Robinson et al. Marketing and Public Relations, for more than 20 years. Which offers a full range of communication services to private, nonprofit, and public sector partners. She's also been very involved in neighborhood building and community building in New Orleans. And this is, as we've said, this is the 4th of our series in a whole series of webinars that are really designed to inform the New Orleans development and building community, and folks large and small, all different ranges of experience and backgrounds, really about the Finance New Orleans' new sustainably focused direction and programs, but also just to talk in general to help familiarize folks and to help share information about affordable housing development and sustainable development in today's New Orleans. One of the things we really want to make sure that folks know is that Finance New Orleans is here as a community development resource. We've created a platform to work with folks, again, of all from all ranges of experience and different backgrounds, and so we really want to work with folks and meet them where they are, meet you where they are.
And besides learning about different programs that are designed to get more affordable housing built in New Orleans, we do want this to be a forum and for discussion and for information sharing. If you have any questions or just comments that you would like to add, you can do that in the chat box anytime throughout the presentation, and we'll try to answer as many of those as we can at the end. So don't be shy. You can say almost anything you want. So now Lucinda's going to introduce our speaker.
Okay, I will introduce our speaker as soon as I say this. Just a reminder that folks can watch the workshop and in fact the entire developer series on the Finance New Orleans YouTube channel. This will be available afterwards, so you can go back and revisit it and try to take it in for a second time. And first of all, I want to say thanks this morning to our presenter. His name is Victor Chiang, and he's with a firm called Caine, which is they advise housing finance agencies across the country. And last week we talked about low-income housing tax credits, which is one important financing source. And today we're going to talk about another one. Victor's going to talk about another one, Tax-Exempt Bonds 101. It's a complicated topic, and Victor's going to give us a broad overview of really what the bond market is all about, and how developers can tap into it, and how developers need to tap into it. Victor has 15 years of housing-related public finance experience. He provides a wide range of financial advisory services, quantitative investment, and liquidity consulting. He's an expert in the financing of affordable housing, specializing in the best execution of new money and refunding bond structures, variable rate financing products, complex consolidated cash flow projections, and rating agency consultation. So that's a lot. Victor's obviously an expert, and he's gonna walk us through a lot of material. And again, it's a lot of stuff. So when folks, you're welcome to go back and revisit this again on Finance New Orleans YouTube channel, and also to always contact Finance New Orleans. We can help walk you through things. So without further ado, Victor, thank you very much. Victor?
Thanks.
Okay.
All right. So in last week's developer webinar, Cornelius Caine talked about low-income housing tax credits and funding gaps. And today is the second half of that discussion, and I'll be talking about the relationship between tax credits and tax-exempt bonds, how they fit with FNO and LHC's cooperative agreement, and minimizing the funding gap. So we're going to start with some background regarding the relationship between tax credits and tax-exempt bonds, and then we will we'll cover all these topics today in Bonds 101. So to start with, if a project receives 9% low-income housing tax credits, then it cannot also be financed with tax-exempt bonds. If a project receives 4% low-income housing tax credits, then it must also be financed with tax-exempt bonds. And for a project to be eligible for the full value of 4% tax credits, it has to satisfy the 50% test, which is that at least 50% of the basis in the building and land must be financed with tax-exempt private activity bonds. One item to note is that in the numerator for the 50% test, eligible bond proceed uses are the financing of land and building costs, and ineligible bond proceed uses are reserves or cost of issuance.
So Victor, are your slides moving? We're still on the first slide. Have you?
Yeah.
Sorry about that. Yeah.
There we go. There we
Thank
go.
you.
Thank you. That's all right.
So this was the 9% and 4% tax credit differences, where you cannot use tax-exempt bonds with the 9% tax credit. You have to use them with the 4% tax credit. But in order to in order to get the full value of the 4% tax credits, you have to satisfy the 50% test, which I covered already. And then here are the eligible and a few examples of the eligible and ineligible uses of proceeds. All right, so as Damon Burns, Marjorie Ann Willman, and Keith Cunningham discussed in the first developer webinar, they entered into a CEA earlier this year. LHC is the state's housing credit agency and will issue the tax credits. The city will commit financial resources or soft money or gap financing to the project. And then FNO will issue the tax-exempt bonds on behalf of the borrower. They can also award and administer a pilot or a payment in lieu of taxes for the project. And then one item to note here is that per the CEA, the project must have an affordability period of at least 30 years. So there have been three main factors that have combined to move us into a more favorable environment for multifamily financing. One is the housing crisis recovery since 2008, a better interest rate environment, and the availability of liquidity and credit. So in general, housing bonds work best in a high rate, flat yield curve environment. And this graph demonstrates the steepness of the yield curve in the taxable market from March 2007, before the financial crisis, to today. The gray line is the target Fed funds rate, which is an overnight interest rate, and it represents here the rate on short-term interest rates. The orange line is the yield on the 10-year US Treasury note, and the spread between the two lines represents the steepness of the yield curve. So in 2007, the lines were really close to each other, representing a flat yield curve. And then following the financial crisis that began in 2008, the yield curve was steep until 2016, when short-term rates began to rise and the yield curve began to flatten. In fact, in 2019, you can see that there was an inversion in rates. Since COVID-19 affected the financial markets in March, the yield curve steepened, but the spread between overnight and 10-year rates is still only about 61 basis points, as compared to over 3% during the financial crisis. This chart shows the tax-exempt yield curve over the past 5 years as represented by the MMD index, which is an index published by Thomson Reuters of AAA-rated municipal bonds, ranging in maturity from 1 year to 30 years. So each line is 1 point in time. And from 2016 to 2018, you can see that interest rates increased and the yield curve flattened. By September of 2019, interest rates decreased and the yield curve was extremely flat, with the difference between the rate on 1-year MMD and 30-year MMD at less than 1%. Although it should be noted that housing bonds price at a spread to it. Currently, the yield curve is steeper, but rates and therefore borrowing costs are extremely low, at or near record lows. So since the financial crisis in 2008, the availability and liquidity and credit have been increasing steadily. COVID's affected this, but the financial environment has improved since March. So over the past 5 or 6 years, banks and the GSEs, such as Fannie Mae and Freddie Mac, have been more willing to lend credit, which has led to a diverse range of products for HFAs and borrowers to choose from. Each box here represents a different multifamily financing execution. I'm not going to go into them during this Bonds 101 presentation, but it demonstrates that basically there's been a new significant product offering roughly each year. But again, in March, credit was very scarce due to COVID's effects on the financial markets. Since then, credit's begun loosening. And also since the credit freeze in March, there's been plenty of liquidity in the system due to support from the Fed. So the tight but loosening credit and the liquidity are now, are creating a more favorable environment. So as a result of the dynamics described in those prior slides, tax-exempt housing bond issuance has increased in the recent years. The teal bars are the volume of multifamily bonds issued, and the gray bars are the volume of single-family housing bonds issued. Since 2011, multifamily housing bonds issuance has been returning to pre-crisis levels faster than single-family. In recent years, there was an upswing, and multifamily bond issuance approached their highs from 2003. The data are from the annual bond buyer yearbook, so the 2020 figures aren't out yet. But since March, the multifamily segment of housing finance has been trying to reestablish itself. So the market has moved to a multifamily, so that multifamily financing has become more attractive, and there are a number of products to choose from. This lists the typical sources and uses of a tax-exempt bond issue. And a source that we're going to focus on in the coming slides will be soft money or gap financing. And a couple of uses to focus on deal with upfront transaction costs and negative arbitrage. So a good starting point in choosing the product is going with the one with the lowest mortgage rate. This is a simplified example of a project that needs $50 million of upfront financing sources from both bond proceeds that finance the permanent mortgage loan and from gap financing. If the borrower's interest rate is 4.5%, then the income generated from the project in this example can support a $32 million permanent loan, which would leave about $18 million of gap financing needs in order to get up to the full $50 million that are needed upfront. However, if the borrower can access a product that results in a 4% interest rate, the project's income can support a $35 million mortgage, which would reduce the financing gap to $15 million. With soft money and high demands, a lower borrowing rate can allow a project to be financed that otherwise wouldn't be financially feasible. So of course, it can't be as simple as just choosing a product with the lowest mortgage rate, and other considerations are needed. So this chart lays out the current mortgage rates and upfront transaction cost indications based on rates as of last week. We're not going to go into what each of these financings are on this webinar, but the point is that in addition to the mortgage rate, you'll need to focus on the uses we highlighted a couple slides ago. So as you can see in the last column, upfront transaction costs can vary widely among the different financing products, which can have a large impact on the gap financing that's needed. And finally, there are other considerations. For example, certain financing counterparties may not want to face your or the developer's credit. And some mortgage loan products can vary widely in their processing times. So it may be worth the extra borrowing and transaction costs. It means you can close quicker. This final section is designed to expose you to some common key items relevant to any multifamily tax-exempt bond issue. And this slide will cover some key items in the schedule. Every bond issue has to have a public hearing called a TEFRA hearing, during which the public can comment on the use of the tax-exempt funds and the financing that's in question. And in Louisiana, a private activity volume cap application needs to be submitted to the State Bond Commission, who will then approve the bond issue. Another key milestone is receiving your loan commitment and the credit enhancement for your loan, for example, from Ginnie Mae or Freddie Mac or Fannie Mae. Then, as we chug along, the bonds are priced and sold to investors. And then as quickly as 1 or 2 weeks after the pricing, the bonds close, and then the real estate closes. So there are a large number of documents involved in both the real estate and bonds side, but this slide will just go through a few of the key bond documents. FNO or any issuer has an act or enabling legislation that creates them and gives them the power to issue bonds. And then there's the trust indenture, and in conjunction with this would be a supplemental indenture. And so the trust or bond indenture is one of the most important documents for a bond issue. It's the contract between the issuer, the bondholders, and the trustee. The trustee administers the funds and assets in a fiduciary capacity on behalf of bondholders. The indenture establishes the rights, duties, and responsibilities of the issuer and the trustee. It determines the security for the bonds, and it states the general terms and conditions under which an issuer can issue more than one series of bonds. The preliminary official statement is the disclosure document for the bonds that investors view before the actual bond sale. It describes the purpose of the issue, how the securities will be repaid, and the characteristics of the issuer and the issue. Upon the sale of the bonds, the bond purchase agreement is signed, and it's a contract between the underwriter and the issuer that sets forth the final terms of the bonds. And then after that's signed, then the official statement is updated, which just updates the preliminary official statement for the final terms. Crucial to any tax-exempt bond issue is the bond counsel opinion and the tax certificate, which basically allow for the tax exemption on the interest in the bonds. And another document will be the regulatory agreement, which is important for you as the developer because it would lay out income and rent requirements and describes financial reporting and annual inspection requirements. So in this slide, we're going to go over the many parts that go into the initial funding of a multifamily process. And quick disclaimer, this is way oversimplified. But so we're going to start with you, the developer or the borrower, and you will receive gap financing from the city. You also then receive your allocation of 4% tax credits from the LHC, which you then sell to investors. The teal arrows represent non-cash assets, and the green arrows are flow of cash. Over here, we have FNO issuing bonds, and they're also grouped together with a bond trustee who, as described before, carries out the duties under the indenture. And they're responsible for the movement of bond proceeds and funds related to the bond issues. So FNO issues the bonds, and the bond underwriters sell the bonds to the investors. At bond closing, the investors receive the bonds that FNO issues, and FNO receives the bond proceeds, less the underwriter's fees or the underwriter's discount. In addition, there are other costs of issuance paid to various third parties, such as attorneys and advisors, the rating agency, and the trustee. This money, the bond proceeds then flows to you in exchange for a mortgage note, which is the security and source of payment for the bonds. So now the developer or borrower has your financing sources, and then you can proceed to use the sources to acquire the property and begin construction or rehab on the project. So once the bonds have been issued, this chart demonstrates the flow of funds. So you have low and moderate income tenants who on a monthly basis pay you rent. After you pay for your operating costs, you pass on mortgage payments to the loan servicer, who then passes on the mortgage payments to FNO and the trustee. And then finally, that money is then passed on to investors to pay bond principal and interest. So these are our simplified diagrams illustrating the flows in a tax-exempt bond issue. But like we discussed earlier, there are a number of different financing products and structures. So that simplified diagram can take on various permutations and complexities. Like this illustration, which you can find on the internet, and it demonstrates another financing product for multifamily bonds and the various complexities that can be involved in a tax-exempt bond issue. But all this is to say that there are many, many options out there, many of them complex, but there are also many resources, as Valerie and Lucinda talked about earlier, and FNO would like to be one for you. Valerie, Lucinda?
Okay, well, thank you, Victor. That was very enlightening. And I do believe that we have some questions that have come in. So let's see. And if you have questions, put them in the chat box, please. We got plenty of time to get them today. One question says, does bond financing replace your typical senior debt in the capital stack? What is the maximum loan to cost for tax-exempt bond financing? What are the typical fees?
So yeah, so there are many different ways that the permanent debt can be financed, and bonds would be one of those ways, and it would replace. For example, in a 9% deal, the bonds would replace that. And sorry, what was the second part of that question?
What is the maximum loan to cost for tax-exempt bond financing? What are the typical fees?
I'm not sure I understand the extent of that question.
Are there fees involved?
There are,
Yeah.
yeah, there are a number of fees involved. I think we could quickly go to this slide, which shows the various transaction costs. So, you can see that the transaction costs vary on this slide from 4.3% to 9.19%. And then, just maybe a loan to value was part of the question. So typical, loan to value would be like 85 to 90%.
Victor, I have a question. If you're a fairly small developer, do small scale properties, is this something that I should even think of? I should even think about?
So as you can see, there are a lot of transaction costs. And so your property will have to be big enough to overcome any fixed costs of issuance. So, I think we can, depending on the financing that's used, you can see how the transaction costs will vary. But, perhaps a general rule of thumb could be $5 million and up.
Okay, Valerie, we have another question. What can be included in soft funds or gap financing?
There are a multitude of sources out there, but like I said, resources are scarce. And what we're talking about when FNO would be issuing the bonds, either FNO or the city would be providing that soft money.
So if I want to proceed, I want to explore this avenue, what's my first step?
Well, you have a lot of steps. Because you kind of have to work simultaneously on a lot of fronts. Cornelius talked about how last week 9% tax credits are very competitive. And if you don't get awarded the 9% tax credits, then maybe you pursue the 4% tax credit in conjunction with pursuing soft money. Like you all have discussed, FNO would like to be a resource here. So I would, perhaps reach out to your local contacts there.
So FNO would be able to assist you in finding all that out. Is that what you're saying?
Yes.
Do we have any examples? I don't know if you are familiar with this, any examples of how bond financing has been used in New Orleans? Or would be used typically in a city like New Orleans? I don't mean to put you on the spot, Victor.
Well, we haven't been directly involved in, FNO, as you know, has not issued any bonds for a long time. So, and we have been their financial advisor for a few years. So we have not been directly involved in any of the bond issuances with FNO since we've come on as advisor.
But so this is a resource that's coming back to New Orleans, is what you're saying, right?
That's right. Yeah, FNO is, as you've seen on the prior webinars, they're really excited that the CEA has now been executed. LHC and is excited that we have this partnership going now, and everyone's very excited to kick the program off, and hopefully we'll see 4% tax credits, soft money, and bonds coming back to the state of New Orleans.
Yeah.
Okay, we have another question. It says, are the tax-exempt bonds non-recourse?
No, they're not. Well, in this case, when we're talking about FNO issuing the bonds, the development and the borrower is the credit for the bonds.
Okay.
So there would be no recourse to FNO, but I guess you're asking from a developer's point of view. And I believe in this case, for most of these bond structures, the partnership that is formed would be the credit for the bonds. There would be no recourse to the developer itself.
Ooh, that was a loud noise. And I think, Lucinda, I think you kind of said this. Where would a developer go to find out if he had a project that even qualified for tax-exempt bonds?
Well, I think probably
What stage, I guess, maybe of the project?
What stage of the project? Well, I would probably go back to Cornelius's presentation from last week, where he talked about a lot of the requirements that are necessary when tax credits are being used.
Okay.
To go back on the prior one, that there is no recourse to developer, and typically that's why you have credit enhancement. So insurance from Ginnie Mae or Fannie Mae or Freddie Mac.
Okay, we have another question. What is the minimum debt service coverage ratio for tax-exempt bonds?
So that depends on a number of items, such as the rating agency and the type of bond structure. But typically, we would see at least 115. Debt service coverage ratio. 115 or higher.
Do we have any more questions? Let's see. You got to thank you, Victor, for your answer. Valerie, you think that's it? I think that's it, huh?
I think that's it. This is like our shortest one ever.
Yeah, we know it's a lot of information, and so it's great to kind of have it in one piece that you folks can really, take in and then go back and revisit on Finance New Orleans YouTube channel. So.
Okay, so we do have the upcoming webinars that are currently scheduled. October the 16th, how to finance sustainable development, what's new, what are the advantages and pitfalls. And this is with two experts in the field, O.G. Alexander and
Jonathan Light.
I think that's going to be a really interesting one because they're like boots on the ground people. Then we have Enterprise coming in with their report on green standards. So that should be really interesting in November. And then December, we're going to have an overview of what developers have to know, the zoning impacts, changes, and what needs to happen. And what happens next, basically. So those are going to be, I mean, the last couple have been really about, financing. The other ones, which of course is important because you're not going to do a project without financing. But these other two are going to give you, some really good information on new things and new ways of doing things. So we hope that you'll join us for that. Remember that after today that the program is recorded on YouTube, on FNO's YouTube channel. And we also have the slides recorded as well. So that's about all we have for today. Anybody have any other questions they'd like to ask before we let you out early on a Friday morning? Still morning. All right. Well, then thank you all for coming, and we'll see you in a few weeks. Thank you very much, Victor, for giving us that great information. I'm gonna have to spend a little time with it, I think. But it's good information. All right. Thank you.
Okay, everybody have a good weekend. Thank you.